All right. Welcome back to the Real Estate Locker Room Show, folks. I'm your host, John Carney, and thank you for taking the time out of your busy day to tune in to the show today. I'm truly grateful for all you return listeners out there. Your support is what makes this podcast successful and really inspires me to keep on going. I know your time is valuable, and I appreciate you spending some of it with us today here by tuning into the Real Estate Locker Room Show. If this is your first time listening to the show, welcome. The goal here is to deliver you actionable advice, elevate your real estate investing game today, to continue to raise the bar in your specific area of expertise in the real estate industry. You know, whether you're an investor or an industry pro, welcome to the show that believes real estate is a team sport. Today, we've got a guest. We're going to be talking about note investing here on episode number 82 with Jim. It's Maffuccio.
Maffuccio. Yeah, that's good.
I got you. Well, welcome, Jim. Thanks for joining us.
Thank you, John. It's great to be here.
Awesome. Well, look, we haven't covered this topic yet. Episode 82. We're still learning something new every time, we have a guest sharing their expertise with us. It's the Real Estate Locker Room Show. The premise behind this is to explore the intersection of competitive real estate and competitive sports, right? So I'm always interested in what the people are doing that carve out a niche in the market like you have, and continue to not only be successful in their own right, but really help other people, bring other people into the fold of wealth creation and using real estate as a vehicle. So we're going to dig into that. But do you mind if we stretch out for a minute here first?
That'd be great.
I'm trying to see where my camera is. Is my camera? I've got a camera going. Anyways, okay. So we'll stretch out with a few sports questions. Do you have a favorite athlete that inspired you either today or growing up?
Well, I mean, yeah, plenty of growing up, but I'll highlight today because I have to, because I'm a big Kansas City Chiefs fan, having moved from Kansas City to Colorado about 3 years ago. But it's got to be Patrick Mahomes, man. He's my boy. He's the age of my youngest daughter, and I'm amazed at the poise and the skill. Everybody's amazed by the skill, but the character and the guy's just having fun, and he's really good at what he does. And I think having fun at it really bounces off of being really good at it. And, it makes it more fun, and it makes him even better at it. So I love watching him. And, even when he makes a mistake, which doesn't happen that often, you get a lot of grace because he's just so much fun to watch. And so having that, I'm 63 years old, a little bit older than him, but having some kind of a youthful exuberance and finding joy in what you do on a day in and day out basis. Man, if you can't find joy in what you're doing right now, I would suggest go find something else to do. Maybe be an NFL quarterback,
An NFL quarterback. Well, look, I agree with that. I believe, Richard Branson was one of the first big business people books that I read, 20 years ago, right? Losing My Virginity. And I follow Richard Branson and have always followed him. And I mean, that guy's still charging hard indoors and outdoors at his age. And it's like he hasn't aged. And the whole premise is that business should be fun. I try to express that sentiment to my team. We should be having fun, getting our work done and learning every day. So I subscribe to that for sure. Did you play any sports growing up, or do you participate in any outdoor activities there in Colorado?
Oh yeah. I grew up in the southern US. So, everything was football and football season, and basketball season. Didn't get into baseball quite as much. And then I've always from high school on, I've loved snow skiing and done some racquetball, that kind of thing. I've never been great at any of those, to be honest with you. And basketball was probably my favorite, but towering at 5'8" and not having the springs of Spud Webb. If your listeners know who that is, he was a guy that was 5'7", I think he was, and he actually won the slam dunk contest one year in the NBA. Imagine that. So I realized early on, good man's got to know his limitations, and nowadays that would be stay in your lane, bro. So I had a lot of fun playing sports, but and I learned a lot about life, and got involved in martial arts some in college. That was good. But today it's pretty much at snow skiing and bicycling. I live out here in Colorado now, so it's conducive for both of those.
Right. And I'm a big skier, and judging by the forecast, you guys are getting snow in the high country.
Yeah. Yep. They're open. They're open for business.
Can't wait to get out there. All right, so let's dig into the real estate, component of this. And before we get into where you are now, where you landed now, you were a successful real estate developer. That's a career path riddled with obstacles and something new and exciting every single day. That's the hat I've been wearing today. So, do you want to just maybe briefly talk about your success story, which led to Aspen Fund, and talk about where you are now, and talk about investing in these notes Absolutely. As a way to generate cash flow.
Absolutely. Well, okay. First of all, so my successes that led into Aspen Funds were actually failures as a land developer, because now I did have some successes as a real estate developer, but it doesn't matter where you start or where you are in the middle, it's where you end. And I got dumped out both in the early 1990s on account of the savings and loan crisis, and then again in the in the 2008 mortgage crisis. Again, it's related to the mortgages. So as a small residential developer in Southern California, you are more at the whim of what's the market doing at the particular point in time when you have a product to offer to the public. And I don't know where you're doing your development, John, but in California, it can take 2 years to get a simple lot split. So you're starting a project that might have an entitlement process of 4 years before you ever lift the curtain and here's your product. And if the market's good, you're a hero. And if the market's down, no matter how good your product is, you can lose everything. So I actually went through that cycle twice. And when I landed in 2010, having lost everything and then some, and I had 5 teenagers under roof just entering into college years, it was a challenge. And I had a bit of a spiritual epiphany that the thing that killed me twice as a real estate developer not only was market timing, but was tied to what was happening in the mortgage end of the business. Because if you've been around real estate long enough, you understand that it's a very debt-centered industry. And so understanding the financing and where financing is going is a big part of it. So basically, at the end of the day, it was like the thing that took me down was the debt structure. And I saw a window in that and said, what if I could get over on the other side of that and actually be on the lender side of the page instead of the borrower side of the page? And so I started researching the defaulted mortgage space in about 2010. I went to my first conference, and it kind of confirmed what I suspected, and that is that there's tons of opportunity out there right now as a result of the train wreck, which the Great Recession was. And the place that after doing a lot of study, like where's the best place to take advantage of all this discounted property and then ultimately all these discounted real estate notes, the easiest way for me to get started back into it, and which I felt was going to be recession proof as well, is I want to be the lender. I want to start buying some of this paper. So that's when I really turned the corner, and I leveraged my 30 years of experience in the real estate industry and focused it on becoming a debt buyer, and went into that full time in 2011. And so I've been doing that full time ever since. And now we're a company of about 17 people, and we're really lean and good at what we do. And we've got a couple of successful funds, and we've gone literally from zero. I mean, I started with negative capital in 2011 in this thing. And now we've got a $30 million footprint, and we're probably going to double in the next 9 to 12 months. So I'm just saying that, not like, aren't I something, but just to let people know out there that might be starting from scratch, there is a path forward. There's multiple paths forward. And the real estate industry in general, there's no better industry in my opinion. And there's so many ways to get there. And my particular way was through mortgage notes. And so I'm grateful for that.
Yeah. I mean, well, congratulations, because it's not easy, right? Reinventing yourself for a third time.
Yeah.
And so my takeaway, I don't like to guess, but I mean, I'm gonna throw it out there that you put in X amount of years, right,
Yes, sir.
decades on the development side. It was no accident that you had a book full of contacts and people to call, and you learn by being the borrower that, hey, you took think like a banker to the ultimate level and built your business model around that. So what I'm interested in, and what I love about having these conversations with people like yourself, is that you don't have to buy single family homes, and you don't have to have $30 million to go out and buy a downtown municipality apartment building, right?
Exactly.
There are ways to put your savings to work for you, to generate cash flow, to reinvest that, as you're able to grow your savings and grow that pool, to take some of the stress out of living, right? And what does the future look like? So, what's the offer on the note side? We're just to give you a little context, and maybe you can speak to this. Like, what you're talking about resonates with me, because we're in the process of refinancing our third, large $20+ million project here, in one calendar year. And we've got a land acquisition that's a small deal, $1.5 million, $1.6 million deal. The paperwork that comes along with that from the lender is a development site's 25 pages long. That's the short document, right?
I was going to say that's conservative paper.
That's a short document, but on a land acquisition, I mean, it's it's really like a temporary thing, and it's just mind-boggling, right? Like, so what did you learn, and how are you able to translate into my extra savings going into your fund?
Well, okay. For one, I mean, when you talk about the real estate note business, I'm going to focus that in, zoom the camera down a little bit to talking about the residential mortgage space, because that's where we're focused. So we're not doing land, we're not doing commercial, we're not doing multifamily yet. Now we may move into that. So where we chose to enter into this space is very, it's not exciting in terms of, I mean, we're talking about Americana, we're talking about homes, bread and butter homes where everyday people live, and for the most part, they're back to paying their mortgages again. And so it's not like, it's not development lending. Wouldn't be the easiest place to jump into my business. So we started off buying, I started off buying a handful of, and the specific niche that I focused on was actually junior liens. So these would be like home equity lines behind a person's primary mortgage, which had gone into default in some cases 10 years ago. And, the institution that originated that paper already charged it off. Now, all that means is that it's off their books, and it's zero value on their books. They have to do that from a regulation standpoint, but it's still a debt that's outstanding. So we're able to buy those at, we bought those anywhere from 2 cents on the dollar up to 70 cents on the dollar. And on the dollar means that's the amount of principal balance that's owed. So if it's a $100,000 loan, we've bought some of those as cheap as $2,000, but we bought them as expensive as $70,000 as well. And all of that comes down to how much equity is in the property. Are the people still paying on their first mortgage? And what's the regulatory environment and the laws of the particular state? So we were able to buy in. I was able to get started with very little capital. And again, so now we have these funds. Now, what I've been doing is an active real estate entrepreneur. So my active business is acquiring these loans, and then we have a workout team that engages the borrower and tries to craft a successful exit strategy where, yes, we make profit, but as important, the homeowner gets to stay in their home at an affordable payment, and in most cases get some equity back in their property. So that's that's not passive real estate investing. That's like, think of it like this. Instead of rehabbing homes, we're rehabbing paper. We're rehabbing the loan. Now there's a whole other side of our business which buys performing cash flow. So we buy notes that are already paying, and whether those are notes that have been modified that we can buy inexpensively because the institutions don't want that paper, or whether it's originating some hard money. We do that. Now that's for our passive investors that invest in our funds, and they just get a monthly check, and most of them roll it back in and keep going. So there really are two sides of the business, and passive investors can participate in both sides of our business. But to do what I do, to do what our company does, it's very much not a passive activity. It's engaging a lot of attorneys, engaging servicers, and then reaching out to these borrowers. So again, I love real estate because there's so many places to stick the fork in this thing. It's amazing.
Well, okay. So I think I'm connecting some dots. So let's just go back with a property has, would it be, I don't want to skew the numbers. So you've got $100,000 on an equity line that's been written off by that you're picking up, say for $50,000.
Right.
There's a mortgage on the property and there's equity in the property. It's definitely not passive for you. You're right. The one, right? But you're basically buying that second line, contacting the property owner with the mortgage and saying, here's a solution to pay us back, right. Restructure your mortgage, rates are low, and be, happily owning your house and paying down your mortgage. And that's sort of what you're doing.
Yeah.
Correct?
So the easy way to think of it is you look at what the properties were. So let's just take your same example. So if it's $100,000 equity line, let's just say let's say it's a $500,000 home somewhere in a secondary market in California, for instance. So $500,000 property that maybe the first mortgage is $300,000. Okay. So the second mortgage that I bought for $50,000 has a balance of $100,000. So the homeowner still has equity in their property, even above the full balance of our loan. Okay. So we reach out to that homeowner and say, hey, welcome to Aspen. We're your new lender on your second mortgage. And what is your plan to getting back on track? What happened? How can we work together to resolve this? And, we get everything from, well, we don't owe that money anymore. That's been written off, to who are you? Prove you own it. Won't go into all the drama, but once they realize, yes, we legitimately own the second lien as well as the balance that's owed. Yes, we do have the right to foreclose from second position, and we have to start foreclosure on a pretty significant majority of the loans we buy. We only finish foreclosure on less than 2% of them. And even on some of the ones that we foreclose, we end up selling the property back to the borrower under favorable terms. So, but here's the best case. Here's what happens most often. And here's the win-win situation. So that $100,000 mortgage that we paid $50,000 for, we go back to the borrower and we say, hey, let's look at your finances. Let's see what you can afford. We'll forgive some of the arrears as you make 12 successful payments in a row. We'll craft a loan modification that makes sense for the borrower. We're not setting them up to fail again. And our experience is in doing that and in creating a reperforming note now where they're making some payments to us on a new loan modification, we've just increased the value of that asset that we bought from 50 cents on the dollar to, in that case, maybe 80 or 90 cents on the dollar. Okay, so it's a win-win. The homeowner gets forgiven some debt, they get an affordable mortgage payment, and we make money on our investment. We actually make more money when there's not a lot of equity in the property, believe it or not, and we buy those loans at anywhere from 10 to 20% of the balance owed, and we turn those into 50 or 60% of the balance owed assets just by creating a cash flow stream. So again, we're rehabbing the paper. There's the property, the people, and the paper, and all of those are important. And when in a perfect world, when things are going well, the people are happy at the end of it. They're staying in their home. The paper's cleaned up and it's good. And, and the property stays in the hands of the borrower. And we do that hundreds and hundreds and hundreds of times over and over again.
So the successful outcome, right? Because as any entrepreneur, you're really helping people solve a problem.
Yep.
And so I can imagine that either yourself or your team that's making these initial contacts, once you kind of get through that conversation and you have maybe a menu of solutions tailored to the problem in front of you, do people generally end up better off and grateful for taking that unknown liability away from them, really, correct?
Yeah, they do. I mean, obviously you're going to have some people, there's, quite an entitlement culture that we've created in our system over here. But, for the most part, if people aren't grateful, frankly, they ought to be, because in some of these cases, we're talking about people that haven't made a mortgage payment in up to 10 years. And so what have you been doing with that? What did you do with that $100,000 that you borrowed? And a lot of times people have a legitimate hardship, or they had a legitimate hardship. Now they're out from under the hardship, but it's like they got used to not paying. So it's not the happiest time in their life, but if they really sit down and look at the numbers, like what could happen, like we could actually foreclose and take your home. We don't want to do that. We really want to keep you in the property, and we can share the discount with a borrower, especially if they respond to us early on in the process and we don't incur a lot of legal costs. So some actually express gratitude to us. Others they're really getting a better deal than they would, anywhere else. So whether they're grateful or not, that's really kind of it's up to them. But we know we're helping people. We're helping them stay in their property, and we're also helping our investors. So we're really serving too. And we're also helping the institutions, because they got to get rid of this paper at the end of the day. They're my least, I probably wouldn't be doing this just to help institutions, but I love helping people stay in their homes, and I love helping our investors make an outsized return on their passive investment money. So we enjoy that part of it too.
So we hear you're like the general partner, if I were going to kind of look at a different model. So you're doing a lot of work, and you're able to buy these notes by raising money from outside investors. So passive real estate investing, and then there's real estate investing,
right?
And to me, let's see if we're in agreement over the definition. Okay. I give you $100,000, and I'm going to want a 10% return every year, or just pick any number, 8%, 9%, 10%, whatever it is. And then every month I'm going to get, a check in accordance with that, amortized over a calendar year. Right. And so that is passive, as long as Absolutely. You're doing your job and you stay above water. Right. Yep. But you have a track record. And so, that to me is passive. I'm just collecting a check. I don't have to think about it. And there is a menu of passive investment opportunities out there.
That's right.
So I think we agree on that. Talk about the difference between being passive and the other, having to get your hands dirty in note investing.
Absolutely. I'll give you a perfect example where to make that comparison. So let's just say you're a person with, either you have a day job, or you're a professional, but you also have access to some capital, or you're retired and you're strictly living off of the capital you have, you're putting it to work. So one of the typical ways a person will get involved in what I'll call semi-passive investing is to become a hard money lender. So for instance, you take a California person that's got some wealth, got a couple $1 million, or maybe $250,000. And, the fix and flippers are out looking for money to acquire a house fast at a deep discount, put some work into it, put it back on the market, sell it retail, make 60 grand. And they can't go to a bank for the most part. They don't, you have to close these deals fast, and you have to, and a lot of these people aren't bankable, frankly, and the deals aren't bankable. So a hard money lender will say, hey, I'll loan you 65% or 70% of the finished value of your rehab job. And you're going to pay me, maybe they're doing it in the 7% range in California right now, but let's just say you're going to pay me 10% interest on my money, and I want a monthly payment, and then the whole thing's due in 1 year. If you pay it off sooner, that's fine. Then you go on and do your next flip. So there's people doing that. There's tons of people doing that. So is that a passive investment or an active? I say it's super active, because number one, if I'm that investor with that money, I have to vet the borrower. I have to vet the property. I have to vet the opportunity and the way it's papered up. And if there's a hiccup along the way, if there's a default, now I'm staring at stepping in and finishing a rehab project, which may or may not have the appropriate permits. And why did the person walk away from it? What did they discover that now is going to land in my lap? And now suddenly I have a project to work on. Now I'm a developer. I didn't even intend to be a developer. I wanted to be a passive hard money lender. Okay. So that guy is earning 10% in a perfect world. A hard money lender is going to earn that 10% on their money. But then when that deal pays off, they got to go find the next deal. And hardly ever is there a deal that they've already vetted that's waiting for them the day they get their money back. So maybe their money's idle for 2 months out of a year. So, what does that make that 10%? So are they really making 10% on their money? Over the course of a year, they're probably making more like 8% on their money, right? So to me, in my world, they're an active investor. So I look at somebody like that and say, hey, we've got a mortgage fund where we're doing all the heavy lifting. We're continually buying these mortgages. We're servicing these mortgages. We're fixing them when they break. And you can invest your capital. And by the way, this isn't a pitch for people to invest in our funds, so I can't even do that. Our funds are for accredited investors only. I'm just giving you an example of active versus passive.
That's good.
You can invest in a mortgage. I'll just say a mortgage fund like ours, and it'll pay you a preferred return of 8.5%. Now it's still at risk, but if you look at the metrics and look at the analysis of our portfolio, and you look at what would have to happen for us not to be able to make that preferred payment, it's a pretty significant catastrophe that would have to hit our across the country for us not to be able to make our preferred payments to our investors. So they literally get ACH'd into their account every month, their dividend, if you will, and it's at 8.5% preferred rate. Plus we share a little bit of the profit on the fund. But here's the difference. Our loans are not, for the most part, we do a few hard money loans, but our loans are owner occupied mortgages on bread and butter housing. So these aren't people that are watching the equity in their home and they're watching the real estate market and saying, hey, the market's down. I think we'll default on our mortgage. Let's pull the kids out of school and go rent a house, down the street. Well, who's going to rent to you if you just strategically defaulted on your mortgage? These are people that want to stay in their homes. So we're not really correlated to how the economy's doing. The only reason people stop paying on the mortgages that we own, the kind of mortgages we own in our portfolio, is if there's a loss of job and a loss of income. And even there, it's like these people have to live somewhere. They're going to figure out how to stay if they can. They're going to find another job. They're going to get relatives to help out. And it's a lower risk model. So now you're truly a passive investor and you're making 8.5% from day one and uninterrupted. You're not having to go find the next deal. Now, I want to give a major caveat here. I don't think there's a such thing as passive investment from this standpoint alone. You better do your homework. You better vet whether you're buying a stock on Wall Street or whether you're investing in a private placement like ours. And you're going to be hearing more and more about alternative investments, and people like us that are starting, everybody now that can go to watch a home study course or go to a couple conferences can become an expert, and they're out raising money to do their deals. Buyer beware or investor beware. So once you choose to invest in a fund like that, the investment is passive, but you better not be passive in terms of vetting out the opportunity. I think that's the new area where people are going to get burned in the coming years, because every deal looks good on paper, and nobody has a bad marketing pitch, right? They're all great, but you really have to look under the covers and really have to vet these opportunities out, and then make a good decision and, invest in a fund and go play at the beach and get your check every month. So
I do like that. I don't know. Something that always resonates with me is success. Success leaves clues, right? So, hopefully, investor intelligence, I sort of learned that the hard way.
Yeah, me too.
In my 20s and, I'm in my 40s now. I'm just trying to get a little bit better every day, my friend. But, so success leaves clues. And I think what I'd like to just echo is, I bang the drum that real estate's a team sport, right? If you're going to go buy single family homes or fixed brick and mortar assets of whatever flavor you want, you got to have the right team of people.
Absolutely.
And it kind of goes through, what you're saying in alternative investments, if you want to call it that. I suppose I can imagine the amount of hard work that you and your team put into this. But I mean, at the end of the day, you've got two people that you're satisfying, right? You're helping people rebuild and come back to a level of security in their family home, and you're helping your investors who are taking a risk with you by giving them a little bit of an additional stream of income, which Absolutely. Real estate game, in my opinion, is all about. You got to kind of land in the place where you've got a group of people that you've vetted and you trust, but you got to get in the game and see how it goes, right? Do you find that your investors start off and then reinvest? I mean, is that promote yourself, your company?
Yeah.
You can promote your companies a little bit by saying, we do have a track record. We've been around since 2012, correct?
Yeah. You know what? Honestly, I honestly think we've had zero attrition from day one of investors that have invested with us. And we are just super blessed to have, because of the team that we have, both on our capital side. And, we've gone out and hired the best. I mean, we hired high dollar people to run the operation. We're very compliance minded. We decided from the beginning, my business partner and I really decided from the beginning, we're going to do this right. We're not going to poor boy it. We're going to build it very scalable. We were looking into licenses back in, 7 years ago when people were thinking I was like trying to find reasons not to get in the business, because I was asking, as a land developer, some of the regulations and some of the, bureaucracy that's there. And it's like, look, I want to be prepared for this stuff going in. Like, what are the real traps down the road, because there's a lot of people out there flying under the radar, and, eventually you get caught, not intentionally. I mean, not because you're doing something wrong. You didn't build the foundation deep enough. And so we spent the money on staffing, on compliance, on our legal bills to keep us out of trouble and to keep us, dealing with consumers in the right way. All of that is now paying off, because I believe we have some pretty significant investors that are coming on board. We have mom and pop investors and families, and we also have some pretty big hitting institutional investors that have come on board with us. And these guys they're not passive investors in the definition I gave a minute ago. They give you the proctology exam, and they're looking deeply into our business and into our eyes and coming into our office, and they want to know they're investing, and they don't want to lose their money, and that's why they're where they're at. So I'll toot our horn there and say that we decided at the beginning we're going to invest money back in this company, our infrastructure, our people, and our processes. And now's payday for that, because we have stuff that doesn't break. We run into challenges, but we've pre-thought most of them, and we've compensated for most of them. So I think we're in it for the long run, and I think our investors are in it. Our idea is for generations to pass on generational wealth. And I expect that. I have two of my sons working in our business, and my business partner's oldest son works for us, and they're crackerjack. They're on the top of their game. And the way I see it is we're going to be handing this business down to them. They're really running it now. I mean, we're overseeing it. We're very involved. But I think our investors will still be with us 20 and 30 years from now. That's our hope and our dream on this. So.
It's a great success story, Jim, and congratulations. I mean, that's exciting stuff. I mean, it's a testament to hard work and never thinking about quitting. So, right. Before we wrap this up, there's a little bit of information I want to dig out of you here. Do you have a book that you've read recently, or maybe a favorite business book that you could recommend to our audience?
Well, I'll tell you, I'm going to give you a little bit different answer than you probably usually get here. So I'm not a huge reader. I do I go to conferences, I watch webinars. Books are, okay, I'll just admit it. I'm a little bit adult ADD. To sit down and, for hours in front of a book, that's a rare occasion for me. But I like to get real-time information, real-time education. I listen to podcasts like crazy. I go to webinars, I watch webinars, and I go to conferences. And that's where I've actually picked up all of what I have learned about the note business. But the book I read daily is the Bible. And the book of Proverbs, to me, you look at John Maxwell, he's probably the leading leadership expert in the world. And the guy was a pastor. I mean, the guy's teachings come right out of scripture. He just takes the religious language out of it and makes it digestible for people. But I look at it like it's the owner's manual. It's the way life works. So, I read that daily. I'm really big on, I look at it like this. If I work on my interior life, then what flows out of my life, then I get the practical skills and knowledge to implement that in whatever field I'm in, whether it's relationships, whether it's real estate, or whether it's taking good care of my pet dog. There's one of the things that I notice on some of your podcasts, you ask people for a favorite quote. Well, there's one of mine that comes out of the book of Proverbs is, watch over your heart, or I'll just say, watch over your internal life with all diligence, for from it flow the springs of life. So if a person is settled and at peace and at integrity in their interior life, then what they go out and put their hands on is going to be a reflection of that. And I'm not saying that you don't have to go get the practical skills and knowledge. I just choose that. I don't really get that from static books. Most of the time I get that from talking to people that are doing it. I try to find people that are a little bit ahead of me in the race and say, hey, let me buy you coffee. Let me buy you lunch. People say the best way to learn is from your own mistakes. I have a theory. No, that's actually the second best way to learn. The first best way for you to learn is from my mistakes. Are you willing to let me tell you how I blew it for 20 years so you can shorten that curve and you can step right into the shoulders of success instead of repeating the mistakes? So I listen to people. I talk to people. I love people. This is what it's about for me. So sorry, I don't really have a favorite book other than the Bible. So there you go. That's just me. It's my story.
That works though. And that's good. You've actually shared a lot. You've covered like every question I ask as a follow-up to the favorite book. But if you were going to narrow it down to, we'll call it a pro tip or whatever, across, from your experience in real estate and in business as an entrepreneur, the one thing that someone listening can maybe I listen to podcasts. That's my version of sitting on a rock sometimes, walking the dog or going for a run or in the car in traffic. So what is it that you would pass along as that one thing someone could take from your experience to elevate their game in whatever they're doing today?
So would this be somebody who's looking to transition into real estate, or somebody who's already in and wants to improve? Because those answers would be slightly different and generally the same, but just so I can hit your audience. Why
don't we go with you've started and you're looking to grow the real estate industry.
Okay. I would say, and I'm going to assume that means you want to pursue unlimited growth.
Unlimited growth.
Okay. So not just, I want to deploy this $1 million and then earn interest on it and go hang out at the beach. I'm going to say you're somebody like where I'm at, like I said, I started by myself with my son in the basement of my home. We bought our first notes, and 7 or 8 years later, we're a company that has a $30 million footprint, and we're going to be doubling that probably every 12 months from here on in. And the reason I can say that is because we've built the scalable model. So now I'll say, for that person who has a vision to do that, I would say, for one, never stop educating, spend the money, go to conferences. Conferences are great for 2 reasons. They're great for 3 reasons. One, they can be a lot of fun. And if my business partner hears this, he'll be laughing because he calls me the maestro of fun, because you got to have fun doing this stuff. But really, you get the education, and more important, you get the educators. You meet people that you will learn from and rub shoulders with for the rest of your life if you stay in the space that you're looking at. So a lot of the people that work for us, I actually met at conferences. A couple of the guys, the very first conference I went to, they work for us now. And we're having a great time together building the business. Plus, just continually learning the cutting edge techniques, learning from other people's mistakes. I would say develop a skill of finding out what you are really good at and what resonates with you within the wheelhouse of the business that you want to do. And then have enough humility to say, I'm not really good at 90% of the operations in this wheelhouse. So I'm going to go find the people. You can't do that obviously from day one because it costs money, but I'm going to start thinking strategically, like, as I build this business out, what pieces of it do I not want to be doing in 6 months, in 12 months, in 5 years? And then you put that on paper and you plan that out. And in the beginning, you may be doing it all, but you're doing it all with a view to working yourself out of the jobs, because you're never going to multiply wealth if you're the guy. If you're the guy that's got to be keeping the books and calling the borrowers and working with the servicers. So figure out what you do best and have the humility to go find people that are better than you at all the other stuff, and then partner up with them. And just stay laser focused on the business model that you've made a decision. This is where I'm going to start. Avoid the, he who chases 2 rabbits catches 0, So go find that rabbit and track that sucker down and kill him, skin him, and eat him. Sorry about you,
yeah,
people out there.
Don't be offended by that.
Yeah.
All right. Well, thank you for taking the time today to have a conversation about, your success story, the ups and downs of real estate as a career, and, reinventing yourself and building an awesome business doing it. So where can the audience find you to carry on the conversation, Jim?
Okay. Well, there's going to be I think with the materials that are going to be on your podcast, we're going to provide an exclusive link to our website through the program notes at the bottom of your podcast.
Great.
And so that would be the best way. It will be a custom front door for specific to your audience. And if for some reason they can't find that or that's not posted, our website is aspenfunds.us. And you could just, surf around on that and go to the contact link and just shoot us a quick message of who you are and how you heard about us and what it is that you'd like to know. So we can direct you. We have some resources that we can give you for free. Again, we don't sell training, but we can point you to some conferences and to some trainings. If this is an area you want to get involved actively in, hey, all I ask is that you shout out and let me know, and maybe we'll shake hands at a conference together sometime. If you're interested in our funds and our business model, then also indicate that in the contact, in the remarks area, and somebody will get back to you, and we'll see if we're a good fit for each other. But wish you the best. And real estate's an awesome, awesome business. It's the worst day in real estate is still better than the best day working the corporate job, in my opinion. So.
There you go. Well, thanks. There you have it, folks. I hope you picked up some actionable advice. There's all sorts of great stuff in this episode. And my conversation here with Jim Maffuccio.
Yes,
I got it. All right. Make sure to check out the Real Estate Locker Room Show on iTunes, Stitcher, Google Play. We're on Spotify now and iHeartRadio. Hopefully a few of you folks are tuning in there. And with the video podcast, we're also on YouTube. Make sure to subscribe so you never miss out on the pro tips and actionable advice that we receive from our guests like Jim here. And if you like what the show's all about, I'd be grateful if you'd leave us a review. That's the currency these days for helping other like-minded people, find the content that you're enjoying, tuning into. The post-game report, show notes, links, and additional content related to my conversation with Jim about note investing and links to Aspen Funds will be available on my website. That's going to be John Carney Online /podcast. And this is episode number 82. Remember to stay focused on your goals, have fun, and stay in the game. I'm your host, John Carney. And until next week, work hard, play hard, and raise the bar. And one more time, Jim, awesome conversation. Have a great day.
Thoroughly enjoyed it. Thanks, John.
All right. Before you leave,